For decades, the global financial system has been telling a comforting story. That value is real, that prices reflect truth, that markets are efficient, that trillions of dollars resting inside stocks, bonds, real estate, and derivatives represent something solid, measurable, and dependable. But beneath that story lies a far more uncomfortable reality. Much of modern financial value is not anchored to productivity, cash flow, or tangible output. It is anchored to belief, to expectation, to the assumption that someone else will always be willing to pay more tomorrow than they paid today. This is the illusion, an illusion so large, so widely accepted, that it now measures in the tens of trillions of dollars. To understand how this illusion formed, you have to look at how value itself changed over time. In earlier economic systems, value was constrained by scarcity. Land was finite. Labor was physical. Production required effort and time. Growth was slow, limited by real-world constraints. Money represented something tangible: goods, labor, resources. Modern finance severed that connection. As credit expanded, money stopped representing what already existed and began representing what might exist in the future. Debt allowed tomorrow's productivity to be spent today. Leverage allowed small amounts of capital to control enormous positions. Derivatives allowed exposure without ownership. None of this was inherently wrong. In fact, it accelerated growth, innovation, and prosperity. It allowed economies to scale faster than ever before. But it also introduced a critical vulnerability. Value became increasingly abstract. Assets were no longer priced based on what they produced, but on what people believed they could produce under ideal conditions. Growth assumptions stretched further into the future. Risk was discounted. Volatility was smoothed away by models. Markets stopped asking whether value was justified and started asking whether it could be sustained. As long as prices kept rising, the illusion held. Central banks played a critical role in reinforcing it. After every crisis, intervention became faster, larger, and more aggressive. Interest rates were cut. Liquidity was injected. Markets were stabilized. Each intervention sent a powerful signal. Declines would be met with support. This changed behavior. Investors learned that risk was asymmetric. Upside was rewarded. Downside was cushioned. The rational response was to take more risk, not less. Leverage increased. Asset prices detached further from underlying fundamentals. Over time, this created a system where price itself became proof of value. If something was expensive, it must be valuable. If it was rising, it must be justified. If it was supported, it must be safe. But price is not value, and liquidity is not stability. Entire asset classes began floating on expectation rather than substance. Growth companies priced for perfection. Real estate valued as if rates would never rise. Sovereign debt treated as risk-free regardless of fiscal reality. Each layer added distance between value and reality. The illusion deepened. Financial engineering made it worse. Assets were bundled, sliced, and repackaged into structures so complex that few could trace the underlying risk. Exposure multiplied without visibility. Losses became theoretical. Correlations were assumed away. Risk did not disappear. It became unreadable. At the same time, global capital had nowhere else to go. Low interest rates punished savers. Safe assets yielded nothing. To preserve purchasing power, money was forced into riskier assets. This wasn't speculation driven by greed alone, it was survival. The system demanded participation. As trillions flowed into markets, valuations stretched further. Traditional metrics were dismissed as outdated. New narratives emerged to justify extreme prices. Technology, disruption, scale, network effects, all real forces, but stretched beyond reason. The illusion was reinforced by success. As long as markets rose, critics were ignored. Caution was framed as ignorance. Skepticism was labeled pessimism. History was dismissed as irrelevant. And yet, the system became more fragile with every upward move. Because the higher valuations rise without corresponding fundamentals, the more dependent they become on perfect conditions. Low rates forever, constant growth, endless liquidity, stable geopolitics, cooperative markets. Perfection is a dangerous assumption. When even one condition breaks, the illusion strains. The problem is not that markets correct. Corrections are healthy. The problem is when value collapses because it was never there to begin with, only confidence was. That is when the illusion is exposed. Losses cascade not because assets suddenly became worthless, but because expectations were wrong. Leverage amplifies the adjustment. Liquidity vanishes. Forced selling accelerates decline. And suddenly, trillions in value evaporate. Not stolen, not destroyed, simply revealed as imaginary. This is the uncomfortable truth of modern finance. Much of what we call wealth exists only as long as belief remains intact. When belief falters, numbers disappear faster than they were created. The illusion does not end all at once. It deflates unevenly. Some assets hold, others collapse. Some institutions survive, others fail. But the system as a whole is forced to confront the gap between price and reality. And when that happens, consequences follow. Not just for markets, but for societies. Because asset inflation shapes inequality. It rewards ownership over labor. It concentrates wealth among those already positioned to benefit. When the illusion breaks, the pain spreads outward, to jobs, pensions, public finances. What looked like prosperity reveals itself as imbalance. This is why the illusion matters. It is not an academic concern. It determines who gains, who loses, and who pays when reality returns. And history shows that reality always returns. And when reality does return, it rarely announces itself clearly. It arrives quietly, disguised as a rate hike, a missed earnings target, a tightening of liquidity, or a shift in sentiment. At first, the system absorbs it. Markets adjust. Commentators explain it away. Confidence holds. But the illusion weakens. What was once supported by endless optimism begins to rely on justification. Narratives grow louder. Defenses become more elaborate. And that alone is a signal, because real value does not need constant explanation. Eventually, the system reaches a limit. When belief can no longer compensate for fundamentals, repricing begins. Not as a dramatic collapse, but as a slow realization. Returns flatten. Volatility rises. Safe assumptions fail. The margin for error disappears. This is when participants discover the difference between value that is created and value that was merely assumed. The illusion does not vanish completely. Some assets remain strong, some prices adjust modestly. But the era of effortless growth ends. Risk demands a premium again. Capital becomes selective. Confidence becomes conditional. And the system resets, not to fairness, not to balance, but to realism. The danger is not that the illusion existed. The danger is believing it can last forever. Because in finance, Value built on belief alone is never permanent. It holds only until conditions change, and conditions always change. This is why understanding the illusion matters, not to predict collapse, but to recognize fragility before it becomes unavoidable. Because the greatest risk is not volatility. It is mistaking confidence for permanence. Welcome to Cash and Chronicles, where money, power, and history collide.